Joining me now, Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli, and also joining the conversation all morning long, Strategic Wealth Partners President and CEO Mark Tepper, and columnist for The Hill and Fox News contributor, my Fox and Friends buddy, Joe Concha. Great to have all of you here this morning. Joe and I, of course, see each other every morning. We've got a lot to go through here, Joe, but first let me just, Chris, this is what the American people are talking about. This is what they are seeing and what they are feeling. And now we get confirmation yesterday that the Fed is indeed seeing and feeling the same things that Americans are. The issue here, though, is that what the Fed does is going to affect the markets, and we've had this very strong stock market for 2021. Now we're rolling into 2022, and this is kind of the firecracker that may be, this is the fireworks show that we're about to get with the markets. And Chris, we got it yesterday, as you saw.
Yeah, absolutely. You're correct. Yesterday we saw a lot of that volatility that we were expecting coming into 2022. As you pointed out, last year was a really good year for the stock market. We've had a couple of years now where the Fed has been very loose, or in the case of 2020, actually adding trillions of dollars of accommodation into the markets, into the economy. So now in 2022, the story is going to reverse. We're going to be taking a lot of that liquidity out of the market. You're going to see the Fed start to raise rates. Now, I do think it's more of a story of volatility for this year, meaning ups and downs. I don't necessarily think we're going to have a full year down year in the markets. It's just going to be a lot more choppy this year because there's a lot more headwinds than what we've seen so far.
Yeah, and Mark, get into this, because obviously what we saw yesterday in the minutes, we saw definitely a much more hawkish Fed. And the yield in particular, I want to bring up the 10-year yield issue, because that could be a problem for the banks as we move into earnings season, Mark.
Yeah, so, I mean, yesterday we heard that the Fed is going to take a more hawkish stance on inflation than I think a lot of people initially thought. Not just tapering and raising rates, and tapering is buying fewer bonds, but actually beginning to wind down its balance sheet by selling bonds, which is, it's a brand new concept, right? So, and you saw a pretty big nosedive in stocks after that, especially in the higher multiple tech names, right? So, Chris, I got a question for you. I read through your notes. I think we're all concerned about inflation, but let me ask you this. I mean, what do you think is the bigger risk to the market in 2022? Inflation running too hot, or the Fed being too aggressive in fighting inflation, in tightening, in unwinding its balance sheet? Which is the bigger risk?
I mean, I think the Fed's the bigger risk. I mean, clearly inflation is what's driving the Fed's actions. And so you can say inflation is the cause of what's driving the Fed to make that huge pivot, one that Powell made in December. And then in the minutes, it was revealed that the other members maybe are even more hawkish than Powell let on as of last month. So I think ultimately it's the Fed that drives everything. If the Fed gets really, really aggressive, runs off the balance sheet in addition to raising rates too quickly, that's a risk for the markets. Now, I think the Fed it has to act quickly because of inflation. They're going to start moving, and you're seeing that already. However, I do think they are going to be somewhat patient if they can get a little bit ahead of the inflation numbers. So ultimately, it's the Fed that I think drives liquidity and will impact the markets most. But without a doubt, inflation is the reason that they're acting the way they're acting.
Hey, Chris, we're going to get into this later on the show, but before you go, I got to ask you about the technology sector. Obviously, we're seeing with futures right now, the NASDAQ is lower again. Broad-based sell-off for technology stocks yesterday. This higher rate environment, in particular for the bigger names, those big winners that we saw, and you can pick a name, I'll pick a name, I'll talk about Alphabet, I'll talk about, Facebook, Meta, whatever you want to call it. All of these names were such strong stories for 21, but for 22, a lot of discussion that these are names that are going to have some problems.
Absolutely. I agree with that. And look, big tech has been a great story in terms of earnings and revenue growth. It's been phenomenal, stocks performance as well. However, with lower rates, you're able to get into those higher duration assets, longer duration assets such as tech. And those big tech names, they were trading around 26.5 times earnings as of yesterday. You look at the S&P 500 around 21.4 times earnings. So, tech was 25% more expensive than the rest of the market. Yields are going higher. higher interest rates in general are not as good for technology, very bad for high PE stocks, as you mentioned, and ultimately that's the risk in your portfolios. I'm not saying you need to get out of tech completely, but you definitely, all those people who had a real overweight in tech, that's going to hurt you in 2022. That's something that you'd want to reduce, I would say.
Sure. Maybe not sell a name like Apple, but maybe wait. If you say you like Apple, that was one of the stocks we just showed our viewers. You wait until you see a little bit of a dip in that one. And from what we've seen yesterday and what the Fed said yesterday, we're going to probably see more dips for these names. Chris Zaccarelli. Chris, thanks for being here this morning.
Thank you.
All right.